If they can't go into Western sovereign debt, they're going to go into gold. And as more people understand that, why would you sell your gold? No, like there's a tidal wave of money coming for the next 30 years of surpluses every year, relentless buying of gold. You would have to be an idiot to sell your gold in front of that. Hey, sovereigns are going to buy $1 trillion worth of gold for the next 30 years. How much would you like to sell today? None. I'm going to buy more. I'm going to participate alongside them as the system rebalances through gold. The problem with the dollar system that these people leave out is it's become a victim of its own success. There is no threat to kick your head in anymore because guess who makes all the weapons that we're going to use to kick your head in? China. China makes critical components of the weapons we're going to use. And why is that the case? Because of the dollar system. We literally, there is the only place there's still a threat that we're going to come kick your head in is on Western Wall Street investors.
Lukegromen explains that as global fiscal imbalances deepen and real rates remain negative, nations are moving away from Western sovereign debt toward gold. He believes that over the next 3 decades, relentless accumulation by sovereigns could amount to trillions of dollars annually. Selling gold, he argues, would be unwise when global reserves are rebalancing toward tangible assets instead of depreciating paper instruments. Gromen further highlights that the US dollar system has become a victim of its own success. Once backed by industrial strength and military dominance, it now suffers from over-reliance on foreign manufacturing, especially from China. Ironically, the same nation the US seeks to contain now produces critical components for its defense systems, weakening its strategic leverage. Ultimately, Lukegromen foresees a shift toward a multipolar order anchored in real assets like gold, commodities, and sovereign self-sufficiency. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think that those charts are going to continue to converge over time. You have to have control of your FX reserves and knowing the fiscal situation of the West, which is they have to have negative real rates to make their debt not implode. It's a double whammy, right? Surpluses occur naturally. It's just, some countries buy and sell more. It's usually around oil and commodities. You're going to have some level of surpluses over time. Those are not going back into Western sovereign debt. I don't think ever again, unless those two conditions are satisfied. If they can't go into Western sovereign debt, they're going to go into gold. And as more people understand that, why would you sell your gold? No, like there's a tidal wave of money coming for the next 30 years of surpluses every year, relentless buying of gold. You would have to be an idiot to sell your gold in front of that. Hey, sovereigns are going to buy $1 trillion worth of gold for the next 30 years. How much would you like to sell today? None. I'm going to buy more. I'm going to participate alongside them as the system rebalances through gold. It's interesting because a gold standard implies the gold being pegged to a value of currency and then the gold moving as it was structured for many, many years, centuries, with a few exceptions up to, call it, the 30s. And so the people that rail against the gold standard, they are fond of pointing that out. And they're fond of using Keynes's words. And I think it's very disingenuous that they do that. They know exactly what they're doing. And why do they do that? Because they want to maintain control of the system that they have. I understand it. If I was in their shoes, I'd probably want the same. And so they lie by omission about that period in history. They lie by omission that Keynes proposed something called the Bancor at Bretton Woods, which was a neutral reserve asset made up of commodities that you would settle, that would rise in price to balance imbalances. And so what I'm describing is not a gold standard. What we would be on is not a gold standard. It would be Keynes's Bancor. It's a neutral reserve asset, and it would fluctuate in value in every currency to reflect inflation expectations, reflect trade balances, right? So America runs massive, massive deficits. The world's just not going to stockpile treasuries anymore. They're going to start buying gold. Oh, by the way, this is what the world has been doing for the last 10 years. That puts upward pressure on gold in dollar terms. The more deficits America runs, the more the dollar is going to fall versus gold. The more gold the other currencies have, and the price still going up in their currency, just maybe more slowly than in dollars, you're going to end up getting, say, for example, the yuan rising against the dollar. What is it that the American government wants the Chinese to do? They wanted them to strengthen the yuan versus the dollar, right? So step one in which it is beneficial for the U.S. is, what does American policymakers want China to do? They want them to strengthen the yuan, stop with mercantilist policies. Check. And they want the Chinese to consume more of their own production. Well, the Chinese government paradoxically has been encouraging the Chinese people to buy gold for the last 25 years, right? So it's a paradox because they're authoritarian and communist, except their government's been encouraging them to buy gold while our government's been encouraging us to buy the paper of central control, which are treasuries. Can't make this stuff up. So as the price of gold goes up, Chinese balance sheets are going to improve. Chinese consumers are going to have more money to buy their own production. The move in gold year to date has improved Chinese balance sheets by over $1 trillion in 1 year based on their holdings. 1 year. Over the last 5 years, it's like $4 or $5 trillion that their balance sheet has improved. So at a high enough price of gold, China consumes more of its own production. Its balance sheet issues are fixed vis-a-vis real estate. It strengthens the yuan relative to the dollar. And then, sort of the other thing, it takes away our sanctions. But this is, I think, one of the things that so many Western commentators miss. Behind sanctions is a perceived threat. Let's call it what it is. We're going to put dollar sanctions on you. And if you don't play ball, we're going to do to you what we did to Saddam. Everyone forgets we had sanctions on Iraq for like 10 years. And then when they started breaking down and Saddam went to he left the dollar and went to the euro, he announced that in October of 2000. And you can find articles about in early 2003 about how much money that had made him moving to the euro from the dollar he had supported the euro because it was 5% of world oil production. The threat was, we're going to come and kick your head in. The problem with the dollar system that these people leave out is it's become a victim of its own success. There is no threat to kick your head in anymore because guess who makes all the weapons that we're going to use to kick your head in? China. China makes critical components of the weapons we're going to use. And why is that the case? Because of the dollar system. We literally, there is the only place there's still a threat that we're going to come kick your head in is on Western Wall Street investors. In the real world, U.S. policymakers, U.S. military people, U.S. military strategists, the Chinese, the Russians, they all know. The U.S. ran through 15% of its high-end air defense missiles in 11 days of medium combat in June, helping defend Israel. What do we got? A month? 2 months? 3 months? And oh, by the way, these missiles take years to replenish. Everybody knows this. And oh, by the way, China makes critical components in these missiles across services, like of a startlingly high percentage of these missiles. So like literally, if China should, and how, I knew this ahead of time. When you look at how the American administration has reacted to the shutdown of military grade rare earths, have you ever seen the American administration react this way to anything? Anything. Why? They're acting like an addict who just had his supply cut off.
Luke Gromen observes that growing global trade surpluses are pushing nations to move away from Western sovereign debt, largely because of unsustainable fiscal policies and persistently negative real interest rates. As a result, capital is shifting toward gold, which offers long-term security outside the debt-driven Western system. He highlights that China's decision to restrict VAT refunds on gold sold from the Shanghai Gold Exchange reflects its intention to retain domestic reserves and curb exports, reinforcing gold's strategic role in its monetary framework. Gromen further explains that the US dollar's geopolitical dominance is eroding as America's economic and industrial dependence on China deepens, a neutral global reserve asset to balance trade and inflation. This evolution points toward a multipolar financial order, where gold and real assets, not paper debt, anchor stability.
I think it is a critical and a super astute question, because the first principle off which almost every American investor is operating is, well, this will be just like 1980 when, this will be like the 70s, right? So we went off the gold standard in 71 and gold went up a bunch, and then Volcker came in and raised rates and gold went back. It was just a trade. There was a debasement, but Volcker took care of it all. Well, Volcker took rates to 15%. If the Fed did that to stop that, if the Fed took rates to 6 today, they would literally blow up the entire, not just stock market, but housing and the treasury market. We know this. This is not speculative. We've seen empirically the treasury market dysfunction multiple times, well before 5% over the last 5 years on the 10-year. So there's the first principle view that most investors are investing on is that, there will be a reversion. And something we wrote for clients a few weeks back was, let's look at the debasement trade in Indian rupees. And if you call up a log chart of gold priced in Indian rupees going back to 1985, it looks like this. And there's like little dips along the way. But in the end, it looks like Apple. If you go and you look at Brazilian real, gold priced in Brazilian real back to 2000, log chart. looks like this, up and to the right, with little dips along the way. So am I saying gold's never going to dip again? No, of course not. I mean, it's probably in the corrective action now. What I'm saying is that the most important thing to determine to answer that question is to look at the fiscal situation of the U.S. and ask yourself, is it really the same as the U.S. in 1980, as the U.S. in 1970, as the U.S. in 1960? Treasury calls up Powell. Besson calls up Powell, says, okay, revalue it from 42 to 10,000. It's going to put, mechanically, you can find this in the Financial Accounting Manual for Federal Reserve Banks. It's a public document online, section 2.10. Treasury can call the Fed and say, revalue the gold. It mechanically creates a deposit right into the Treasury General Account, or TGA. It's literally money creation using the gold that Besson can do pretty much whatever he wants with. At 10,000, it's $2.5 trillion. At 20,000, it's $5 trillion. $5 trillion, you could buy back a lot of the Treasury market. You could buy back, let's put it this way, you could buy back the entire long end at $5 trillion, all of it. And so paradoxically, most people would say, oh, if gold's at 20,000, there's no bid for treasuries. It wouldn't need to be. He could buy the entire long end. Treasury yields would go down. 10-year treasury yields would go down in that case, not up. Would it be inflationary? Eventually. Is that what we need? Yeah. If we wanted, again, we can either win and bring back our defense industrial base, or we can have low inflation and a bond market that, requires China and all the two preconditions. We can't do both. But right. So that's sort of one form of paper gold. That's, fully reserved paper gold. You get into things like gold futures, which are sort of levered, but for every buyer, there's a seller, but there's some amount of leverage in there. There's way more paper trading every day on the COMEX than there is physical gold that they have by a wide margin. But again, in futures, for every buyer, there's a seller. Where a lot of the leverage has historically been in that business is what is called unallocated gold, right? Centered in London. You have allocated gold, which is, I buy gold from you, London bank or London branch of an American bank, and it is fully allocated. In other words, it is mine. I've got a number. Here's the bar numbers. Boom. That is mine. There is a very long legal precedent that is my gold. Then there's unallocated gold, which is buy me $100 million of gold. Done. Okay. And that is not gold. That is gold credit. And if anything happens to that bank, you are a general creditor of that bank. And at one point in time, that unallocated gold number was estimated to be 20x, 50x, 100x. Who knows? Nobody really knows. It's a big number. Within the context of all of this, that's the most risky sort of paper gold, right? Then futures, there's leverage involved, et cetera. That's puts and takes. But again, you don't own gold. You can get cash settled, right? In a crisis, go back to the Hunt brothers, right? When they tried to buy up futures to squeeze silver and then take delivery, what did the powers that be do to them? They turned the futures sell only. So no longer you could no longer buy futures, only sell, and they wiped them out. And so that's an example of, if you don't hold it, you don't own it. And when you look at ETFs and various ones, again, I think they all have the gold they say they do. That's not the risk point. The risk point is it's sitting in London in a lot of cases, as in the case of GLD. And if there's a real monetary crisis, that unallocated gold market means there's way more people than there are seats when the music stops.
It's like fractional reserve?
It's fractionally reserved within the city of London itself. And then it becomes a political question. You, as a GLD or ETF holder, are one-to-one reserve, no question. What if the Saudis are shorted gold? Who's going to get that gold? The Saudis? The Russians? The Chinese? Or you, Mr. Retail GLD holder, or retail ETF holder? That's why I don't know the answer to that question. Why I'm proposing that question is that is the question every investor in gold needs to ask themselves of their custodian. If you want to buy GLD, you want to buy any other gold ETF, great. The risk you are taking is, in a real crisis, it is entirely possible, I'm not saying probable, but it is entirely possible that they say, Friday, we have a crisis over a weekend. Sunday night, gold's trading at some really big number, and the ETF goes, due to unforeseen market circumstances, we're declaring force majeure, and all holders of this instrument, this paper instrument, will get cash, dollars, cash, your currency, whatever, at the Friday night closing price of where gold traded. And then you get to take that gold and go out and buy your own gold on Monday morning when it opens at the new price.
Comparing today's US economy to that of the 1970s or 1980s is misleading. In earlier decades, the Federal Reserve could raise interest rates aggressively without destabilizing the system. But now, even slight hikes threaten the treasury, banking, and housing sectors. Gold, once treated as a cyclical investment, has become a structural hedge against mounting fiscal fragility. Analysts suggest that revaluing gold could unlock trillions in liquidity to support debt markets and ease long-term yields. However, this raises a critical concern. Would investors in paper gold ever receive the metal they believe they own? With ownership claims in ETFs and unallocated accounts far exceeding physical supply, Gromen warns that only direct possession of physical gold offers real security in an era where confidence in paper assets continues to erode. Hit that like button if you found value here, and share this video to help more people understand where the world of money is truly heading.